Today, we're focusing on business law and securities regulation, particularly how these areas work together to protect investors. We'll explore the key principles of investor protection, especially in the context of online securities transactions. This includes understanding how securities laws, disclosure requirements, and the duties of broker-dealers all combine to create a secure environment for digital trading. It's essential to grasp how these regulations help maintain trust and transparency in today's fast-evolving markets. The history of U.S. securities regulation reflects a gradual evolution aimed at protecting investors and ensuring market integrity. It all began with the Securities Act of 1933, which focused on requiring truthful registration and full disclosure for new securities offerings. This was a critical step toward transparency, helping investors make informed decisions. Then, in 1934, the Securities Exchange Act established the Securities and Exchange Commission, or SEC, an expanded regulation to include securities markets, brokers, and ongoing reporting requirements. This act laid the foundation for continuous oversight of the markets. Fast forward to 1975. Market structure reforms were introduced to develop the national market system, improving transparency and oversight of trading practices across exchanges. These reforms aim to create a more efficient and fair trading environment. Most recently, the 2008 financial crisis led to comprehensive reforms focused on tougher enforcement, enhanced risk controls, and significant post-crisis regulations to prevent a repeat of that turmoil. An important theme throughout this history is the shift from paper prospectuses to digital platforms, reflecting how technology has transformed securities regulation and investor access to information. Each stage builds on the last, emphasizing disclosure, oversight, structural reform, and accountability to protect the integrity of the markets. The Securities and Exchange Commission, or SEC, plays a crucial role in the financial markets. Its authority lies in registering and regulating key participants like exchanges, broker-dealers, investment advisors, and ensuring that public companies provide accurate disclosures. The SEC's mission is threefold: to protect investors, maintain fair and orderly markets, and facilitate capital formation. What's important to note is that these responsibilities extend beyond traditional markets. The SEC also enforces these protections in the digital space. This means online trading platforms, app-based transactions, and electronic securities are all under its watchful eye, ensuring the same level of investor protection and market integrity regardless of how trading occurs. When we talk about investor protection within the federal framework, it's important to understand that this protection is built on multiple layers of laws and reinforced by strong oversight and market supervision. The foundation starts with two primary acts: the Securities Act of 1933, which focuses on the initial offering of securities to the public, ensuring transparency and preventing fraud, and the Securities Exchange Act of 1934, which governs the trading of securities after they are issued, setting rules for the secondary market. Supporting these are key laws like Sarbanes-Oxley, which enhances corporate accountability and financial disclosures, and Dodd-Frank, designed to increase financial stability and protect consumers after the 2008 crisis. Oversight is maintained by regulatory bodies such as the SEC, FINRA, and state regulators, all working together to enforce these laws. Altogether, this framework creates a comprehensive legal environment that safeguards investors and promotes fair, transparent business practices. Online securities have truly reshaped how we invest by bringing the markets directly into our pockets. Thanks to digital trading platforms, the costs of buying and selling have dropped significantly. Execution happens almost instantly, and investors gain access to a much broader range of stocks, funds, and real-time market data. The core shift here is moving away from the traditional methods like phone calls to brokers or floor trading, towards a fully digital experience where app-based investing is the norm. This means that anyone can place orders instantly and take full control of their investment decisions anytime and anywhere. The market is essentially always on, providing continuous access for retail investors through user-friendly trading interfaces. This transformation not only highlights increased accessibility, but also empowers individual investors like never before. Before a broker-dealer can handle investor orders online, they must navigate a complex set of registration and licensing requirements. This involves multiple layers, including federal regulations, self-regulatory organizations like FINRA, and state-specific licensing. First, they have to register with the SEC, which is the federal regulatory body overseeing securities. Then, membership in FINRA, or another self-regulatory organization, is mandatory to ensure adherence to industry standards. Additionally, broker-dealers must obtain the necessary state securities licenses, complying with rules unique to each jurisdiction. Beyond registration, broker-dealers face ongoing compliance obligations. They must maintain minimum net capital to ensure financial stability and protect investors. Adopting written supervisory procedures is essential to oversee trading activities and prevent misconduct. It's also critical to keep accurate records and submit timely filings to regulatory bodies, which supports transparency and accountability. All these components form a core checklist that licensed firms must complete. Missing even one requirement, whether it's SEC registration or capital maintenance, can lead to enforcement actions and jeopardize investor protection. So the key takeaway here is that every layer, from federal to state, from registration to compliance policies, is indispensable in safeguarding the market and investors' interests. When we look at duties to clients, it's important to remember that even though online platforms operate quickly, the fundamental legal responsibilities remain unchanged. First, the suitability requirement means that any recommendations made must align closely with the investor's goals, financial situation, and risk tolerance. Next, firms have an obligation to achieve the best execution for client orders, which means seeking the most favorable terms reasonably available. Investment advisors also have fiduciary duties, which require them to act with loyalty and care, always prioritizing the client's interests above their own. Lastly, clear and timely disclosures are essential. This includes revealing material risks, fees, potential conflicts of interest, and trading terms so clients can make informed decisions. These principles form the backbone of ethical and legal conduct in broker-dealer relationships. When we talk about standards of conduct in investor relationships, it's important to understand the key difference between suitability and fiduciary standards. Suitability asks a straightforward question. Does the recommendation fit the client's profile, risk tolerance, and objectives? This is the standard broker-dealers follow. They ensure that what they suggest makes sense for the client's individual situation. On the other hand, investment advisors operate under a fiduciary duty, which goes a step further. They must put the client's interests first at all times, showing loyalty and care. This means they have to disclose any conflicts of interest and always act with the client's best interests in mind. These different legal duties shape how investor protection functions, especially in the online environment where transparency and trust are crucial. Understanding these distinctions helps investors know what level of care and responsibility to expect from the professionals they work with. When it comes to disclosure and online brokerage rules, it's essential that all disclosures are complete before the investor even clicks to proceed. Online platforms have a responsibility to clearly present all material terms so investors fully understand the transaction they are entering into. There are 4 key areas where clarity is crucial: fee schedules, investment risks, conflicts of interest, and account terms. Fee schedules include commissions, spreads, margin interest, and any transfer charges. Investment risks encompass factors like market losses, volatility, liquidity issues, and even potential system outages. Conflicts of interest, such as payment for order flow or incentives tied to proprietary products, must be transparently disclosed. Lastly, account terms cover arbitration clauses, account access rules, and the need for electronic consent. Regulatory compliance hinges on making sure disclosures are clear, timely, and easily accessible to the customer. For example, during digital account opening, a disclosure summary might highlight fees, risks, conflicts, and terms upfront. This summary must be delivered before any trade execution and remain available for review. The core standard in all this is full and fair disclosure, ensuring investors have the information they need to make informed decisions at the right time. Insider trading refers to the act of buying or selling securities while possessing material, non-public information, which breaches a duty of trust or corporate loyalty. This means someone with inside knowledge uses that information to trade, gaining an unfair advantage in the market. The consequences for insider trading are serious and can include civil penalties, the return of any ill-gotten profits, known as disgorgement, trading bans, and even criminal prosecution. Liability also extends beyond the trader to those who share this inside information unlawfully, known as tipping. People who receive this information and trade based on it, called tippies, can also be held responsible if they know the information was disclosed in violation of a duty. This is all governed under SEC Rule 10b-5, which requires a duty, knowledge, and benefit to establish liability. Understanding these rules is crucial for maintaining market integrity and ensuring fair trading practices. When we talk about fraud and misrepresentation in online markets, it's important to recognize how quickly deception can spread. Online platforms create an environment where urgency and anonymity allow misinformation to take hold almost instantly, which can severely cloud an investor's judgment. One common scheme is the pump and dump. Here, scammers create false hype around thinly traded securities, causing prices to spike artificially. Insiders then sell their shares at these inflated prices, leaving other investors with significant losses. Another major risk is Ponzi schemes. In these cases, supposed returns aren't generated by legitimate investments, but rather by using money from new investors to pay earlier ones. This is unsustainable and ultimately collapses, harming many. Affinity fraud is particularly insidious because scammers exploit trust within tight-knit groups, whether religious, social. When it comes to compliance and investor data security, online broker-dealers have several critical responsibilities. They must ensure customer records are well protected and trading systems are secure. It's not enough to just prevent breaches. They also need to quickly address any incidents that could put investor assets or confidential information at risk. Core supervisory duties include implementing written safeguards, controlling access carefully, overseeing third-party vendors, and having a robust incident response plan in place. These measures help prevent and manage potential cybersecurity threats. Under Regulation SP, firms are required to protect non-public personal information and clearly communicate their privacy practices to customers. This regulation ensures that sensitive data stays confidential. In the event of a breach, companies may have to notify customers, regulators, and any affected parties promptly, especially if the event is material or could impact investor interests. This breach notice requirement emphasizes transparency and accountability. The SEC regularly examines firms to verify that their controls are documented, actively monitored, and effectively enforced in daily operations. This oversight ensures that cybersecurity compliance is not just theoretical, but practiced consistently. Ultimately, the goal is to protect investor accounts and maintain the integrity of the market as a whole, focusing on the three key principles of confidentiality, integrity, and availability in all security efforts. When a brokerage firm fails, the Securities Investor Protection Corporation, or SIPC, steps in to help protect investors. The main role of SIPC is to return customer securities and cash that are held in the account. However, it's important to understand that SIPC does not insure against investment losses or guarantee the market value of your investments. The coverage limits are set to provide up to $500,000 of protection per customer for missing securities and cash. Within this, there is a specific cap of $250,000 for claims involving cash that is waiting to be invested. It's also critical to note what SIPC does not cover. There is no protection for losses caused by market declines, nor does it cover losses from worthless or fraudulent investment choices. Essentially, SIPC safeguards your account assets from brokerage failure, but does not protect against the risks tied to your investment decisions or market fluctuations. When regulatory violations occur, they not only lead to legal sanctions, but also trigger market discipline, which helps maintain integrity in the financial markets. Some of the most common violations we see include unauthorized trading, where trades are made without client approval; misrepresentation, which involves providing false or misleading information; churning, or excessive trading to generate commissions; and charging excessive fees beyond what is reasonable or authorized. To address these violations, regulators have a range of enforcement tools at their disposal. These include cease and desist orders, which stop the illegal activity immediately, and civil penalties, which impose financial fines. Disgorgement requires violators to give up any ill-gotten gains, ensuring they don't profit from wrongdoing. Bars from the industry prevent individuals from working in securities again, protecting investors. Finally, criminal prosecution can be pursued for severe violations, leading to potential imprisonment. These enforcement mechanisms play a critical role in upholding securities regulation and ensuring that businesses operate fairly and within the law. The combination of market discipline and legal action serves as a powerful deterrent against misconduct in the business and financial sectors. Here we see some notable enforcement actions from the SEC and FINRA that highlight the challenges digital trading platforms, advisors, and promoters face. These cases illustrate how issues like speed, scale, and technology can sometimes compromise investor protection, leading to penalties. For example, in 2020, Robinhood paid a hefty $65 million settlement over misleading statements related to payment for order flow and the quality of trade executions. Then, in 2023, Coinbase was sued for allegedly operating an unregistered exchange, broker, and clearing agency, highlighting the critical importance of proper registration. In 2022, Kim Kardashian faced a $1.26 million penalty for promoting a crypto asset without disclosing her compensation, underscoring the risks associated with disclosure failures in digital promotion. Overall, these real cases reinforce that compliance gaps in disclosure, registration, and digital marketing remain key areas regulators are watching closely, signaling real compliance risks for industry players. When it comes to investor protection and due diligence, the key is to develop informed investing habits rather than relying solely on how convenient an online platform may seem. First, always verify that your broker is properly licensed. This ensures they are regulated and held to industry standards. Next, make sure you truly understand the risks involved with any investment. Nothing is guaranteed, so being aware of potential downsides is crucial. Regularly review your account statements to spot any unusual activity or errors early on, and be cautious of unsolicited offers, as these can often be scams or high-risk pitches. A best practice is to thoroughly check registrations, disclosures, and any relevant records before you send any funds. Remember, reading and understanding before you risk your money is the foundation of smart investing. As online investing grows into tokenized markets, a critical challenge emerges around legal protection. This protection largely hinges on whether digital assets are considered securities under existing laws and how swiftly regulators adapt to these new technologies. One key issue is the gap between how fast tokens are developing and the slower pace of regulatory classification. Tokens often evolve more quickly than the categories designed to define them, creating uncertainty for investors and businesses alike. Additionally, platforms dealing with these assets face increasingly strict compliance requirements. They must carry out rigorous anti-money laundering and know-your-customer processes, ensuring thorough user verification, ongoing risk monitoring, and the reporting of any suspicious activities. This heightened scrutiny aims to protect the market, but also adds complexity for operators. The Securities and Exchange Commission's stance on when a cryptocurrency offering qualifies as a security is still evolving, which means guidance is continually being updated. This evolving classification impacts how laws apply to digital assets and influences the broader landscape of business law related to this dynamic sector. Understanding these emerging challenges is crucial for anyone engaged in digital asset markets. As we look ahead to future regulatory trends, the next wave of oversight is set to be much more automated, heavily data-driven, and focused on transparency through enhanced disclosure. First, RegTech adoption is transforming compliance by enabling real-time monitoring, automated reporting, and machine-assisted surveillance. This means potential violations can be caught early before they escalate into bigger problems. Second, with the rise of algorithmic trading, regulators will likely require stronger controls, rigorous testing, and clear audit trails to ensure that these fast, less human-driven decisions remain in check. Finally, ESG disclosure requirements are becoming increasingly important. Future regulations may push companies to standardize their sustainability claims, making it easier for investors to reliably compare environmental, social, and governance risks, metrics, and practices. Together, these trends highlight a move towards smarter, more proactive regulation that leverages technology and data for better business oversight. To wrap up, let's focus on the key principles that protect investors in the digital age. First, strong securities laws set the foundation by ensuring fair disclosure and maintaining market integrity. This is crucial for safeguarding investors. Second, broker-dealers have an ongoing responsibility to be properly registered and licensed, and they must act honestly and ensure suitability in every transaction, even online. Third, investors themselves need to conduct thorough due diligence. Just because online transactions happen quickly doesn't mean you can skip verifying risks, fees, and issuer details. Fourth, continuous oversight and enforcement are essential to prevent fraud, insider trading, misrepresentation, and cybersecurity breaches. Finally, as markets evolve with new platforms, data practices, and digital assets, regulations must adapt accordingly to keep investor protection effective. These principles together form the backbone of investor protection in our rapidly changing digital securities landscape.